Have you ever taken some time to research a stock, buy said stock only to watch it fall, sometimes immediately after purchase? Thinking to yourself, well, I must have got it wrong this time, so you sell the stock. It's a win in your mind, as it was surely going to go down much further. Then to your dismay, you watch the stock start climbing, eventually past the point of your original buy. I guess I was right all along, and you end up rebuying the stock, this time at a price higher than originally, leaving you with less shares, which cost more. In this video, I'm going to go over some common psychological phenomena when it comes to investing. Stick around or jump to the end, where you will find some tips to help you avoid the dreaded buy high, sell low scenario. Investing in stocks boils down to the following 4 words: buy low, sell high. Easy enough, but why is it so hard to pull off? Seems simple enough, right? But have you ever sat down and actually tried to do it? In this video, I'm going to go over the main reasons why investing is so hard. And at the end, I'll give some tips at how to overcome some of the main pitfalls most investors run into. So why is buy low, sell high so hard to actually do? Because humans are inherently emotional, and when emotions get involved, well-laid plans go out the window. Investing in the stock market is as much about managing emotions and psychological responses as it is about evaluating company fundamentals and economic indicators. Many investors, regardless of experience, grapple with psychological factors that influence decision-making processes, often leading to less than optimal investment choices. In this video, we will touch on some psychological phenomena involved in investing, some of which you have likely heard and even exhibit yourself, some of which you probably exhibit but have never heard of. Let me know in the comments if you too are afflicted by any of these, as I think at one point or another, I've suffered from them all. 1. FOMO. Let's start with the one that we've all heard of. This actually transcends investing. You've undoubtedly heard it said, and probably said it yourself. I've got fear of missing out. Essentially, the same as the herding effect, it is a powerful psychological force that can cause investors to make fast, unresearched decisions, typically motivated by herd mentality. This can often lead to bubbles and crashes, and might explain why every time I jump on the bandwagon of a stock, it seems to crash. Typically, by the point you have reached the FOMO stage, we are at the buy high point of the stock, which will lead to the sell low point for most amateur investors. 2. Anchoring bias. This is one I bet you haven't heard of that you probably exhibit. When you fixate on the first price you see for a stock and use it as a reference point for all future decisions, whether that price is relevant or not. Think about a time when you've been researching a stock. For the longest time, it might be hovering around $100 a share. A few months later, the stock drops to $90 per share following a market downturn. Seeing the price drop, you think this is a great buying opportunity because you have anchored yourself to the $100 price. Your perception has the $90 price being significantly undervalued compared to your anchor. This can lead you to hold on to a stock that's plummeting simply because you anchor your valuation to the price at which you entered, ignoring new information that suggests a different value. 3. Overconfidence bias. I guess this would be the opposite of imposter syndrome. Overconfidence bias occurs when you overestimate your own investing skills or the accuracy of your information. Have you ever heard of the saying, the first one's free? Just because your first stock pick was a huge success doesn't mean it will continue every time. It often leads to taking greater risks, under the belief that you can predict stock movements better than the average investor, which often isn't the case. I know we have all been here at one time or another. 4. Confirmation bias. Have you ever found yourself only seeking out information that supports your investment choices? This bias leads investors to pay attention only to stock analysis that confirm their preconceptions. I'm very guilty of this, and it's definitely a difficult one to overcome. Leave a tip for me if you have one. 5. Recency bias. This one makes you believe that what has happened in the recent past will continue to happen in the future. If the stock market has been performing exceptionally well lately, you might assume it will continue to do so, potentially leading you into risky positions when the market is actually poised for a correction. 6. Disposition effect. This is the tendency to sell assets that have increased in value, while continuing to hold assets that have declined in value. Essentially, it's about cutting off the winners and riding the losers, often due to a reluctance to realize losses and admit mistakes. This one can be tied back into overconfidence bias as well. There's no way I'm wrong on this one, it's going to go back up. Sound familiar? 7. Loss aversion. Investors often prefer to avoid losses rather than acquire equivalent gains. For example, some might hold losing stocks too long, hoping to break even rather than accepting the loss and reallocating resources more efficiently. This can become exceptionally dangerous if you are in an echo chamber. Think confirmation bias again. A real-life example would be joining subreddits based on your stock of choice, typically heavily moderated to show only the positive aspects of the stock. Now, unless you actually seek out alternative viewpoints, this can be detrimental and quite costly to your portfolio. Now, some quick strategies to overcome these psychological barriers. 1. Know your risk tolerance. And no, I'm not saying fill out an investment questionnaire. You need real money on the line to truly see how you handle things. Start off with relative to you, small amounts of money to see how you react to ups and downs in the market. If you find yourself sweating out 1 to 2% swings in a stock, then picking individual stocks is probably not for you. 2. Dollar cost average. Invest over time. You will automatically buy more shares when the stock is down and less shares when the stock is up. You will also typically build your portfolio up slower, having less at risk in the beginning when you are learning the ropes. 3. Diversify. If all your stocks are in the same sector, you will typically see them all going up and down together. Spread out your risk. You might have some days where a sector is down and another is up, and it won't hurt as bad seeing a stock go down 2% when another is going up 3%. 4. Rebalance. This effectively solves the problem of buy low, sell high. It also makes sure you aren't overexposed to one stock at any given time, further reducing your risk. 5. Keep learning and stay informed. Knowledge is power. Thanks for watching. If you have made it this far, please consider liking and subscribing for future content.